Could you just to kind of explain the difference between positive gearing and positive cash flow? Are they the same thing or are they not? And negative gearing, right? And is negative cash flow negative gearing? Like, just so we can get kind of like the definition of terms and get all on the same page
Yeah.
here.
Okay. So when we reference to gearing, gearing is much more around tax. So positive gearing means that the taxable income of the property exceeds the taxable deductions of the property. So that would be that you take council rates, water rates, anything that can be claimed as a tax deduction against the property, even with depreciation involved, which is a non-cash deduction, but part of a deduction that we claim from a gearing perspective. So just remember, when someone's talking about gearing, they're referring to tax. Positive gearing, taxable income exceeds taxable deductions. Positive gearing amount is what you pay tax on. Negative gearing is your taxable income does not exceed your taxable deductions. So taxable deductions are higher than taxable income. That negative gearing then acts as a tax deduction in your return, to which you get then a tax benefit on. So gearing is tax. Cash flow is very different. Positive cash flow is when the total income of the property exceeds the total outflow of the property, which may include principal repayments. So I've seen properties with clients where they are positive geared, so taxable income is positive, but negative cash flow. Why? Because they've started to go on to principal and interest, and that principal repayment eats to their cash flow, which means that they're having to, fork out a little bit of cash to continue to pay down the property. But what I always, encourage to tell people all the time is that, if you do have a negative cash flow property, but it is positive geared from a tax point of view, don't look at it essentially as I'm losing money, because you're not. You're actually paying down the liability, which increases equity. And in the end, we're always after what our net equitable position is. So what's our net worth? Net worth is assets less liabilities. So that's probably the crux of it all. Gearing is a tax implication, whether it's positive or negative, and cash flow is genuine money that comes in versus the genuine money that goes out, which is inclusive of principal repayment. So hope that gives everyone a bit of an aspect of how an accountant or how a property investor should look at gearing versus cash flow.